Hi everyone. I hope I'm audible and visible and the PPT is also visible. So thank you for choosing to spend your Saturday afternoon with us. And while my colleague Kishore and I have interacted with a plethora of clients, something that we've noticed as a pattern is that most people focus on building wealth, but very few focus on managing it well. So that is why we bring this webinar to you, identifying that exact gap. And in fact, by the time when the people realize the difference, that particular leakage has already happened. So if you're someone who earns well, you can invest well, you can even take the right set of risks. But if taxes, let's say, are inefficient, or if your assets are misaligned with goals, if inflation is something that you are underestimating, and if your behavior is something that is kind of overriding your discipline, your wealth slowly leaks and that costs you more. So, this session is basically for those who have built a corpus, but they feel unsure about structuring it. For those who are investing in multiple products, but they don't know if it all works together, how to optimize it, and how to look at it from a long-term perspective. And we'll also be focusing on a few new changes that have occurred over the last year, and basically to guide you through clarity and not noise. So that's what we will be covering in this webinar. And initially, we will be getting a few basics right, followed by some tips on tax efficiency. And then we'll see how we can sort of structure our wealth in line with our goals, right? So I will hand this over to my colleague Kishore.
Yes, good afternoon to everyone. And I just get by starting over this. So getting a few things right will pay off much more comfortable for us. So you don't need to do like 100 things correct to build wealth. You need to get 6 things right. And these are the 6 pillars which is shown on the presentation. First one is having a budget. Second one is insure yourself adequately, be tax efficient, diversify your savings, manage your loan wells, and plan for your future. I want you to take away 3 principles from this slide. First, protect before you build. Insurance and an emergency fund must come before any investments. They are your safety net. Second, grow consistently, not aggressively. SIPs, tax efficient, and goal based investing build real wealth over time, not short term bets. And third, review and rebalance every year. Your circumstances changes. Your portfolio, insurance, and your budget also must adapt with your life. Remember, financial wellness isn't about being rich. It's about making your money work for your life goals. So here we are going to talk about like budgeting and cash flow. Let's start with the foundation. How you structure your money every month. The simplest framework that works is the 50-30-20 rule. The 50% of your take home goes to needs like rent, groceries, EMIs, utilities, and etc. And the 30% goes to wants like dining, travel, entertainment, and etc. And 20% non-negotiable, this goes to savings, your emergency fund, and your investments. Now, before we talk about investing, you must build your emergency fund first. The target is 6 to 12 months of essential expenses. Park it in a liquid fund or a high yield savings account, not in equity, not in long term FDs, because the whole point is that you can access it instantly when life throws you a surprise. Automate 5 to 10,000 rupees a month until you hit your target. And critically, if you ever dip into it, replenish it immediately. That means you have to replenish it immediately. Best places to park this money are the liquid funds, or your high yield savings account or short term FDs. So next slide is about the insurance planning. Now let's talk about something that costs Indian families crores in last week: traditional insurance policies. Here the math. If you pay 1 lakh a year for 20 years into a typical endowment policy, you have invested 20 lakhs. The maturity value is usually around 28 to 32 lakhs. That's a return of roughly 3 to 4%, which is very much below the inflation level. You have actually lost purchasing power over 20 years. A traditional policy can cost you up to 10 times more than a pure term policy for a far less coverage. Example, here the takeaway is that insurance is for protection and investment is for growth. Don't mix the two. And while we are on insurance, please ensure you have an individual health policy with a minimum cover of 10 lakhs plus a critical illness cover. Your employer's health cover alone is not sufficient. The day you change jobs or retire, that covers disappears immediately, and you need an additional additional health insurance cover of around 10 lakhs externally, which is not provided by an employer. Now let us compare the term versus the endowment. Now let's compare the two side by side, so the choice become obvious. The term policy gives you 1 crore of cover for around 8 to 12,000 rupees. This premium changes based on your age and such, but you are giving an for an example of around 8 to 12,000 rupees a year. Endowment policy for the same type charges 50,000 to over a lakh per year for typically 10 to 30 lakhs of cover. Term gives you no returns, and that's the point. It's pure protection. Endowment gives you 3 to 5% returns, which we just saw is below inflation level, very much below the inflation level. On death benefit, term pays the full sum assured, 1 crore, protects your family. Endowment pays a smaller sum plus bonus. So here the recommendation for the term is always you have to go for a term insurance, and endowment you most probably should be avoided. Buy term insurance for protection and invest the difference in mutual funds. Your family ends up far better protected and your money actually grows. Now in this slide, we are going to see about old versus new tax regime. Now to one of the most common questions I get, which tax regime should I choose? The answer isn't ideology, it's arithmetic. A simple thumb rule is this: if your total deduction exceeds 3,75,000, the old regime works better. If they are below that, the new regime wins. Under the old regime, you have slabs going from nil up to 30% above 10 lakhs. But you get to claim the ATC of 1.5 lakhs, HRA, ATD, and NPS also, and home loan interest under section 24B, which is of 2 lakhs limit. Under the new regime, which is now the default for 2020 FY 2025-26, the slabs are wider and lower. Nil up to 4 lakhs. Then it's keep on increasing, then 5%, 10%, 15, 25, and you go for 30%, kicking in. Above 24 lakhs, you get a 75,000 standard deduction. Actually, here in new tax regime, the NPS employer contribution under 80CCD and interest on the let out property also is added. A quick note: many people leave money on the table by missing deductions. 80D for health premium, 80E for education loan trust, 80G for donations, section 24B for home loan interests, and often forgotten 80CCD 1B, extra 50,000 for NPS over and above ATC. The smart use of section ATC. If you have decided the old regime works for you, the next question is which ATC instrument, because not all of them are equal. ELSS, a equity linked savings scheme, is better options for most people. 3 years lock-in, expected return of around 10 to 12%, and long-term capital gains taxed only at 12.5%. PPF, which is solid government backed and it has a triple E status, but A 15-year lock-in and only 7.1%. NPS tier 1 9 to 11%, but it's locked until 60 years old. You can withdraw only at the point of 60 years. EPF is mandatory for like salaried people and it's 8.25%, and it's also like exempted from taxes. And the tax saver FD, it's more or like tax saving FDs, and your NSC national saving certificate is also like average in nature. And LIC endowment, 3 to 5% returns you'll get. Better to avoid it. Here's a pro tip many people miss. Your EPF contribution alone usually fills up most of the 1.5 lakh ADC limit. So whatever capacity is left, use it for ELSS, not for another LIC policy. That single switch can change your retirement numbers significantly. So the next one is about the SGB taxation. What changed after April 2026? For those of you holding sovereign gold bonds, this slide is important because the rules have changed. Earlier, sovereign gold bonds were almost universally tax-free. Now it depends entirely on how you bought it and how long you hold it. If you bought from RBI and hold it till the 8-year maturity, no capital gain tax, most efficient route unchanged. If you bought from RBI but sell before maturity in the secondary market, long-term capital gains at 12.5% if held over 24 months and short-term at slab rate if less. If you bought from the secondary market and held it till maturity, same treatment, there is no automatic tax-free benefit anymore. Premature redemption through RBI window after 5 years, still it is tax-free. Also remember, the 2.5% annual interest is taxed as income from other source at your slab rate. That hasn't changed. The bottom line, gold is no longer automatically tax-free. The intent is clear. Discourage short-term trading and reward long-term. So in this slide, we are going to see about what changed in 2025 for NPS. NPS has historically been criticized for being inflexible. The 2025 changes have addressed almost every one of those criticisms. First, higher withdrawal flexibility. Lump sum at exit increased from 60 to 80% of corpus for non-government subscribers. Second, the mandatory annuity requirement dropped from 40% to just 20%. Third, and this is a huge for the small corpuses. If your corpus is 8 lakhs or less, you can withdraw 100% no forced annuity at all. Fourth, the 5-year lock-in for premature exit have been removed for citizen and corporate models. And the fifth one is that you can now stay invested in NPS until age 85. Earlier it was about 75 years. Your money gets more time to compound. And finally, more flexible withdrawal options like systematic unit redemptions have been introduced. Here's the key takeaway for it. NPS is now genuinely a retirement product, not just a tax saving product. More cash access, less forced annuity, longer horizon, worth a serious second look if you ruled it out here. So in this slide, we are going to look about the new labor codes, what every salaried investors must know. This slide affects every salaried person in the room. The new labor codes redefines what counts as wages. Wages now include basic plus DA plus the retaining allowances. And if your allowance exceeds 50% of pay, those extras may also be treated as wages for statutory purposes. What does this mean in practice? PF contributions. Both yours and your employers are now calculated on a higher base. So your PF deductions goes up and so does your employer's contribution. Your retirement corpus grows faster, but your monthly take home reduces. Gratuity rules also there's a minimum change. Fixed term contractual employees are now eligible after just 1 year. Earlier, they often got nothing. Permanent employees still follow the 5 years rules. The ESI, bonus, PF gratuity, all calculated on this broader base. So payouts improve, but immediate liquidity dips. So what does this mean for you as an investor? Your PF corpus grows faster. That's good for long-term wealth. But your take home will likely decline. So your liquidity planning must adjust. And contract workers finally gets an earlier and end of service benefit. So in this slide, we are going to see about the government schemes, the PPF, the EPF, and the NPS. Let's bring this section together by comparing the three pillars of government-backed retirement schemes. The PPF, where the interest rate of 7.1% and it is EEE tax status, 15 years lock-in, and a risk-free, tax-free maturity. Loan facilities are also available. The catch is that 1.5 lakhs annual ceiling and the returns below equity over the long term. Your EPF, which is 8.25% and is also a EE status, locked till retirement. The beauty here is the employer matches your contribution. The rate is higher than PPF and it's auto-disciplined. You don't have to think about it. The trade-off is locked till retirement with partial withdrawals only under specific conditions. And third is your NPS. It's 9 to 11% you can expect a returns. And it's also EE and at your withdrawal status, it's taxed. Locked till 60, you get equity exposure up to 75% plus that extra 50,000 deductions under the old slab scheme. The trade-off 40% must still be annuitized in the which is revised is 20%. Though as just we discussed that now reduced and now the annuity income is also taxable. A small but important footnote on NPS, 60% of your lump sum at retirement is tax-free. The 40% converted to annuity is taxable as income. Here's the priority order I recommend for most salaried professionals. Maximize EPF first, it's mandatory, and your employer matches it. Then PPF, then NPS for the extra deduction and equity exposure. Use all three in that order and you have built a strong, diversified retirement foundation.
Right. Thank you so much, Kishore. So by now, I'm sure all of us have understood where the leakage actually lies and, things that you all have been missing on. From here on, we're going to be further focusing on how you can actually build the wealth corpus and strategize it in such a manner that it is working towards your goals. So this particular slide that we have here focuses on creating your first crore. So just give me a second. Before that, we have one more slide, which talks about the effect of compounding. So many of us try to overrule this sort of an effect of compounding, or we don't understand it unless someone is actually providing us with the numbers. So here it is. And compounding is not intelligence, it's not even timing, it's just spending time. So if you notice, as the time horizon here increases from 5 years to 7 years to 10 years, the amount invested obviously also increases, but so does your wealth. And your wealth, your gain is actually magnifying even more. So this is the importance of compounding, where if you see that over the course of 20 years, you're just investing a monthly sip of a simple 30,000 and return is assumed at a minimum 12%. While you invest 72 lakhs over the course of 20 years, your total value is becoming 3 crore, which is almost 4x of the growth, right? This is just a simple monthly SIP calculation, but if you club this with step ups and ensure that you are regularly increasing your SIP along with increase in income, your goal of reaching that 1 crore it just becomes shorter. So this is what the effect of compounding highlights. And what we've seen many times is that people tend to stop their SIPs when markets take a fall because they're scared that, what if it goes down further? But that is the exact myth that we try to bust, where, when the markets are falling, that's when investors actually have to participate even more aggressively so that they can lock in the units at a cheaper rate. And given that all of us in this room are looking for long-term wealth creation, This is a very powerful tool. Spilling into the next slide, which almost also talks about the same thing. The only difference is the strategy or the path is tweaked here, right? So here we just talk about how a monthly SIP of 10,000, 14,000, and 20,000, if you club it with different kind of step ups, how it makes you reach that particular goal of yours. So in all three scenarios, we reach a corpus of 58 lakh. Just that your initial monthly investment and your step up differs based on your cash flow and your requirement. So what we have to understand here is that the moment we have our salary increasing, we have to ensure that our SIP also increases, because if salary increases, automatically it just so happens that our expenses will also increase. We will start spending more, but we tend to forget, or we tend to overlook that we also have to increase our SIP, and that is what will help us reach the goal where we want to go to, right? So these two slides are basically highlighting the importance of compounding. And now that you have built some amount of wealth, how and where do you allocate it? So we have seen people's portfolios that are skewed extremely towards property. At the end of the day, that does not generate as much returns, right? So we try to optimize such portfolios. So here each asset class has a very stark role to play. We need to ensure that we are diversified right, in the right amount and in the right context of the market. So to dive deep into this slide, first asset class very well is our cash and its equivalents like savings bank. This is just to ensure liquidity and so that you have some amount of cash handy for any emergency, right? And ideally, you should keep 6 months of your monthly expenses in an emergency fund, which will be handy to you, right? And as previously quoted as well, you need to ensure to replenish the emergency fund and maintain it at a certain level based on your expenses, as and when you try to tap into it. Secondly, the asset class that we're going to talk about is gold and silver, something which has been in talks for quite some time now, and it was the king of returns in 2025, right? So gold and silver traditionally is sort of an emotional investment if you look at it in the physical form. But in general, gold and silver are used just as a cash proxy or a hedge to inflation, and you need to ensure that you have some amount diversified into the same, whether it's through, let's say, ETF route or through the physical route, right? Mostly physical is going to be for your personal use. So that is on gold and silver, but given the current market scenario and how it has been performing and being majorly driven by momentum at this point, this particular asset class is a gray area and something that we can sort of keep away from, rather focus on asset classes like equity, given the current market scenario, right? Next up, we have our provident funds, fixed deposits, or maybe let's say your debt equivalent also, where the intention is more on capital preservation rather than capital growth. So this is different from your emergency fund or your cash and cash equivalents, where certain instruments that fall in this asset class might have a certain lock-in, and the focus majorly there is to preserve your capital, right, and provide you with certain regular income. Some people use this particular rule where which is called the 100 minus rule. So if I'm 30 years old, you do 100 minus 30, which is 70. 70% ideally should go into equity, and 30% is what should remain in debt given your age. Similarly, if you are 40 years old, then it becomes 60-40 in equity and debt respectively. But of course, this is just it's not something you can anchor to. It all depends on your portfolio and your requirements, but just a general rule that people tend to use. Moving forward, we have real estate, and something that all of us find it hard to accept is real estate does not beat inflation in the long term. That is the hard truth. And we need to ensure that we just have what 40 to 60% of our net worth at a later point in life into real estate and build a good amount of corpus in equity as well, right? So that, and secondly, real estate is again like physical gold and silver. It has that emotional edge to it, but you need to ensure that your asset allocation is in such a manner where you're not completely skewed towards real estate, right? um, Moving forward to the last asset class, which is equity. This is the asset class that you need to resort to if you're someone who's looking for long-term wealth creation, and you need to ensure that you don't tap into it and just basically the idea for you to invest in equity should be such that you put the amount and forget it, and you try to go all into equity when the markets provide such opportunities. So this is on the asset classes. But something that you also need to ensure, apart from just being diversified, right, is that number one, your asset allocation should be aligned with your goals. So if you are someone who has a short-term goal of 3 years, then equity might not be the right investment vehicle to park most of your wealth in, right? So you need to ensure that your assets are allocated not only as per the market, but also as per your goals. And secondly, you need to ensure that you rebalance your asset allocation as and when the markets move, or maybe every 3 to 6 months as per your preference. Because there are times when people are doing things right, they create a proper asset allocation, and then markets move in a certain way. The markets are not going to move as per your or my asset allocation. The markets move in a certain way, and that asset allocation that they previously took so much effort to build is probably not achieving the purpose. So that's so having the assets diversified right is as important as rebalancing. Sorry, I stand corrected, the other way around. Rebalancing is as important as having your asset allocation sorted and diversified. Okay, going forward to good debt versus bad debt. Something that we all need to understand is that if, for example, the markets are giving you 12%, but you are paying 30% on your debt, that's at the end of the day negative compounding, right? So we need to have a differentiation between what is good debt and what is bad debt, and not resort to bad debt, because it is only going to be having you in a trap. So good debt is something like a home loan. So you can also take tax benefits under section 24B, which was previously mentioned as well, like up to 2 lakhs, right? And for let out, the properties, the interest amount is deductible without a cap as well. On Secondly, we have the education loan. Again, this is a good debt because the underlying is basically the education that you're gaining, and at the end of the day, you that is going to basically boost your cash flow at a later point. So again, you have deductions under 80E that you can claim for the education loan as well, with no upper limit and probably up to 8 years also if you opt for the old tax regime, right? Lastly, business loan is also a good debt because you're basically using that leverage in your business to generate that cash flow at a later point. So the key point here is that if your return on investment from the asset is more than the cost of debt, you can very well go for it. It also builds your credit, right? Moving on to the bad debt end, right? So something that these are like impulsive debts that people end up taking, which is credit card debt. So most credit cards charge anywhere between 36 to 42% annual interest if you revolve the balance. So that means if you don't clear your dues fully, the bank is compounding against you, not in your favor. So if you're again, the simple example that if your mutual fund is itself giving you 12%, but your credit card costs you 36%, your at the end of the day not investing. It is basically going into leakage. So that's where you have to stop. Secondly, we have like personal loans that people end up taking. They usually come at 12 to 18% interest. They're usually unsecured. And basically, a personal loan is not creating any asset like a good debt, right? There is no underlying, there's no good underlying to it. So you just end up paying double-digit interest for something that doesn't even grow in value. So, for example, like if you're taking a loan for a vacation, maybe the memories of the vacation might stay, but the EMI stays longer. So instead of doing that, you should just try to not resort to such bad debts. And lastly, something which I call a very good scam, which is buy now, pay later, which has been something that people have started resorting to after we've been shifting to e-commerce. So this might feel like, okay, I'm buying now, paying later, that's harmless, but it encourages, number one, it encourages overconsumption. And number two, many people don't even realize that they are processing fees, penalties, and maybe delayed payments charges, right? So it creates the illusion that something is affordable for you, but it actually isn't. So the key rule here that I want you to take away is if you have any bad debt, you should clear that off even before investing. So while you're investing, you should ensure that all your money is channeled into the right set of places at the right set at the right time. Uh, After clearing all your bad debts. So that is the key takeaway that we have from this particular slide. Moving forward, this is a hot topic of discussion, which is buying versus renting. So, in this slide, we will be breaking down which is better and which suits whom and what you can take. So, this is a very emotional decision, but we've tried to, put it forward in a mathematical manner. So, the simple thing is that if you are looking to buy your, let's say, taking a down payment, you're contributing a down payment of 20 lakh, and maybe the EMI over 20 years goes up to 1.3 crores. Something that people tend to overlook while they're purchasing a property is stamp duty, registration, interiors, maintenance. All of these are ancillary costs. So we also have to ensure that we take that into account. So the total cash outflow that is going in this particular time period over the 20 lakh down payment is around 1.75 crores. And even if you assume 7% annual property growth, which is something that is aligning with the long-term housing data, the net gain is 1.35 crore. So let's suppose instead of buying, you rent and invest at the same time. Where is it that you stand? So if you're going to be investing the 20 lakh of down payment, the EMI that you're paying, that also you are going to be investing as an SIP instead of an EMI. Again, at 12%, this growth, after 20 years, you're at 3.77 crores. So this does not have any liquidity trap. There's no maintenance risk also here. And the net gain, if we see, is about 1.35 crore, which is almost equivalent to buying with very minor difference, right? So that is the point that we're looking to highlight. So the total out of the total investment corpus, of course, we are subtracting the rent paid also over the course of the years. That's why we end up at almost same as buying or renting and investing. But the point here is you might ask that if the net gain is more or less the same, then what should I go for? So this decision is not just emotional, but it also has to be financial and strategic. So with respect, keeping the emotions away, if we're just talking about math and financials, you can go for buying if you're looking to stay in the place for 10 plus years, stay in the city basically for 10 plus years. If your EMI is coming to less than 40% of your income, which is a healthy extent of cash outflow. And lastly, if you are looking for some stability in your life, go for renting if you value your liquidity your career mobility matters, and you sort of want flexibility and at the same time build wealth. So the whole point here is buying is not wrong, renting isn't inferior either, but you have to ensure that you do your math right and keep your emotions in control before jumping into such big investment decisions. So now we move on to goal-based financial planning. The idea of this whole webinar is to ensure that you are investing based on your goals. You need to ensure that every single penny that you're putting in, every single amount that you have built till date is tagged towards any of your financial goals, because you need to ensure that at the end of the day, your money is working towards your own goals, right? And it should not be such that you've built wealth and it's everywhere and you do not know what to do. This is just a quick ready reckoner examples of financial goals and what are the investment avenues that you can resort to in order to reach them. So for your emergency fund, we've already stated this 2 times in our webinar previously, how important it is. You can park it in liquid funds so that you have easy access to it as and when there is some requirement. Then going forward, let's say you have a goal of your child's education. This is an important goal, which is why you can map mutual funds backed by a little amount in PPF, which also gives you benefits on tax. And it's just that it is a long-term goal. You never know where equity might lie at that point in time. So you have a good balance between equity and mutual funds. Equity and PPF. Going on to your child's marriage, which is naturally a longer term goal, you can park gold, which again is something that people usually pass on as a legacy corpus, and your equity mutual funds towards it. Your house purchase can stay in balanced and hybrid funds, which give you exposure to a good set of asset classes. For your retirement, already previously stated, NPS and EPF are good instruments that you can resort to and build on for your retirement, along with, let's say, a push from the mutual fund end. And if your goal is, let's say, none of this but pure wealth creation, you just want to create wealth, then you can obviously resort to a simple equity SIP, and we can very well strategize that further towards any goals that might arise at a later point. Going forward, we will, now that we have sort of planned your assets and your goals, we also need to understand the impact of inflation. Many people fail to recognize this while they are planning for their financial goals. So it's very simple that, if you consider inflation at 7%, real growth of 1 lakh is quite small. So we need to ensure through this slide that your goals are always inflation adjusted. And I mean, to put in layman terms, always consider or anchor to a worst case scenario and always have a worst case scenario approach when it comes to your finances, right? So it's a very simple math that today's 1 lakh is going to be valued differently in 10 years, 20 years, and 30 years. So the real purchasing power is something that is decreasing year on year. So to give you a quick example, for example, if you're planning for your child's engineering degree, education inflation is something that we can assume at 10%. In today's cost, you want 15 lakhs. But in 10 years, that goes up to almost 40 lakhs. And 15 years, it almost goes up to 62 lakhs, which is almost 4.2 times, right? So what is it that you have to do? Your child's engineering degree goal is, for example, 15 years from now. You need to build 62 lakhs after taking inflation of 10% into account. Start the SIP of 16,000 a month for the next 15 years. Of course, at any given point in time, any lump sum can be parked or SIP can be increased. But as we said that we can take the worst case scenario, you need to start an SIP of 16,000 a month if you want to achieve this goal, inflation adjusted 15 years from now, right? Moving on to one of the most important goals that many people tend to overlook. They think that, okay, my children will take care of me post my retirement. Of course, they will, but as we said, that we need to take the worst case scenario. We will be just drawing a few assumptions and calculating what your retirement corpus should look like and how you, on in your personal capacity, can also look to calculate your retirement corpus. So let's assume you retire at 60 and a life expectancy of 85, inflation at 7%, post-retirement return. So you'll be resorting to an SWP strategy post-retirement, right? So that post-retirement return is at conservative 7%, and your monthly expenses are 60,000. So your retirement corpus is ideally calculated based on your monthly expenses when you retire, life expectancy, and the inflation numbers that we consider. So, given this situation, you need a retirement corpus of 5 crores. If you're starting to build this corpus at the age of 35, you need to start with a monthly SIP of 30,000 and be consistent. If you're starting 5 years later at 40, the monthly SIP that you will be contributing now will be 55,000, which is more than what you had to contribute if you started earlier, right? So that is the cost of delay, where if you keep delaying your building a retirement corpus, you just might have to keep contributing more in order to just build it. So that this particular slide, what you can take away is you can build your retirement corpus over three major pillars. Again, as previously stated, which is NPS, your EPF, and your equity. So the next slide is, this slide is just highlighting, it's a graphical representation of how even 1% can make a huge difference. So, and we've given the math as well, how important compounding is as a financial tool, right? So that brings me to the end of the session. You can take a screenshot of this particular slide and assess yourself how you are faring with respect to your financial health, right? So to summarize what we have covered across this 50 minutes, what you have to ensure in order to stay in line with your finances and your goals is that you have to chart down a monthly budget. It can be in any way, whether through Excel, through an app, or just paper or pen, but you have to ensure to chart down your monthly budget, and you need to know where your money is going so that you can avoid such leakages, which actually cost you a lot. Second, you need to focus on your saving and investment patterns. Once you know that where your money is going, you need to maintain an emergency and a medical reserve. This is a non-negotiable. Even before investing, something that you need to ensure is to build these reserves, these contingency reserves, and to close any debts that you have. Moving on, you need to review and rebalance your portfolio. So as we said that your not we did, it just doesn't stop with your asset allocation. You also need to ensure that you review and rebalance it annually or as and when markets move. You need to keep your taxes in order, be well informed of what's happening so that you can optimize the deductions and be well aware of how you can optimize your particular finances. You need to ensure adequate life and health insurance, as mentioned. You need to ensure to plan for short and medium term goals, and for the long term goals as well, you need to make sure that you are accounting for inflation. Plan and invest towards retirement, and always have a will and keep your nominees also updated. So this will ensure ease for the next generation. So you can just take a screenshot of this slide, tick what you think you have been doing consistently, and just score yourself where you stand. And we will be further happy to guide you on this. So that brings us to the end of the session. Thank you so much, everyone, for joining in. I hope this session provided you with some clarity.